Some companies make oodles of cash investing in other assets and then pass on some of those profits to their shareholders. Hold on to your seatbelts, folks. This is going to be a good one. Asset management companies are financial firms that invest pooled funds from clients into a variety of assets such as stocks, bonds, real estate, and of course other securities. Their goal is to generate returns for their shareholders. Of course, they still want to get paid themselves as well, and their revenue is primarily created via management fees, as well as some of them do have performance fees for when the fund is doing very, very well. How do they work? Typically, they develop investment strategies that align with their clients' goals, risk tolerance, and time horizons. They may invest in a diversified portfolio of assets to spread risk or focus on specific sectors or regions. The success of an asset management company depends on its ability to outperform benchmarks and deliver consistent returns to clients, which in turn, of course, it attracts more assets under management, and that, of course, increases the revenue. There are some big benefits to investing in an asset manager. First, you are getting a much more diversified investment. In many ways, it's a lot like investing in an ETF. In both cases, you get a reduced level of risk as your investment is spread over multiple assets. There is also a strong potential for growth, as these companies often benefit from, something we call economies of scale. So as they grow their assets under management, it reduces the overall risk as they can further spread those investments out. They can also provide a hedge against inflation, as they will often include inflation protective assets such as real estate and infrastructure. Finally, they are run by some very smart cookies. They have access to top expertise that allow for top management of their portfolio. That, of course, equates to higher returns for us, the shareholders. One great strategy for an amazing return is hitting the sub button and then watch the channel grow as you enjoy dividends of regular content. For today's list, I was, of course, looking for companies that invest in other assets. So you have asset managers as well as income funds. I did eliminate any company that failed to produce a positive total return on their year to date. I also demanded that they have a positive return on equity, as we do want the company to be profitable. Today's list is sorted, as usual, by their year-to-date total return. So without any further ado, let's do this. Kicking off this list, we have Power Corporation of Canada with a ticker of POW. They are based out of Montreal, and they are a diversified management and holding company with interests in financial services, renewable energy, and other business sectors. One of their investments just happens to be Wealthsimple. At the time of recording, their price comes in at $36.71. They have a market cap of $23.75 billion. Their beta reflects pretty average volatility at 1.05. Their earnings per share come in at 4.39, and they have a price to earnings ratio of 8.36. That return on equity, that comes in at 11.29%, and they have a return on assets of 0.39%. When we switch over to debt, their debt to equity ratio, that comes in at 48.02%. Looking at their dividends, they have a yield of 6.129%. It is a quarterly dividend of 56.3 cents per share. The payout ratio on that comes in at 49.53%. When we look at returns on the 3-year return on investment, that comes in at negative 14.11%. Factor in the dividends, we do get a total return of 0.28%. On their 1 year, that return on investment comes in at negative 4.53%. Add the dividends, total return 1.13%. And on the year to date, their return on investment comes in at negative 2.44%. Sprinkle in some dividends, we do get a total return in the positive 1.94%. So they just scraped their way onto the list today. Their numbers are much lower than they should be, and I do expect to see them rebound as we move deeper into rate cut territory. Coming in at number 4, we have Brookfield Asset Management with a ticker of BAM. They are based out of Toronto, and they are a leading global alternative asset manager with, you hear it, $1 trillion in assets under management. They invest in real estate, infrastructure, renewable power, private equity, and credit. And let me tell you, those investments are spread across 30 different countries. Their current price comes in at $54.39, and they have a market cap of $22.78 billion. Their beta, a little bit of volatility here, 1.84. Their earnings per share come in at 1.47. They have a price to earnings ratio a little up there at 37. That return on equity, 16.13%. Their return on assets, 0.78%. Their debt-to-equity ratio is coming in at a nice low 0.12%. That's not too shabby. Looking at their dividend, we do have a yield of 3.853%. It's a quarterly dividend of 30 cents USD per share. The payout ratio on that is a little high. It's 125.23%. This version of BAM was spun out of the old BAM back in December of 2022. So the 3-year is much closer to a 1 year and 8 month. So that 1 year and 8 month return on investment comes in at 23.81%. Factor in the dividends, we get a total return of 30.87%. On the 1 year, that return on investment comes in at 15.11%. Total return, 19.07%. Year to date, return on investment, 3.78%. Sprinkle in those dividends, we get a total return, 6.56%. I do love BAM a lot, and I think this is a company with a very bright future for sure. Taking our third spot, we have CanoeEIT Income Fund with a ticker of EIT.UN. This community favorite is based out of Calgary, and they invest in a diversified portfolio of income-generating securities, including, well, equities, bonds, and some fixed income as well. They are heaviest in energy, healthcare, and financials. At the time of recording, their price was coming in at $13.94. They have a market cap of $2.48 billion. Their beta, that's coming in at 1.17, and they have earnings per share of 0.74. Their price to earnings ratio, that comes in at 11.90. They have a return on equity of 12.51%. That return on assets, 10.76%. Their debt to equity ratio, once again, another low one. This one's coming in at 5%. When we look at their yield, their dividend yield comes in at 8.608%. They are a monthly payer of 10 cents per share. The payout ratio on that, though, a little bit on the high side, 161.78%. Canoe will employ return of capital. So when this payout ratio creeps up like it is right now, you're pretty much assured that there is some return of capital happening behind the scenes. This is a great stock, but I highly suggest it is best for a registered account to avoid higher capital gains. Looking at that 3-year now, we have a return on investment of 15.30%. Add in those dividends, we get a total return of 45.08%. On the 1 year, that return on investment comes in at 5.13%. Factor in the dividends, we get a total return of 14.18%. On their year to date, their return on investment comes in at 7.98%. And factor in the dividends, we get another total return of 14.18%. Yes, believe it or not, the 1 year and the year to date had the exact same number. That's just how the math worked. I actually stopped filming for a second to go double check when I saw the numbers the same. But nope. They're accurate. This has been a reliable monthly payer for a very long time, and I suspect they will more than likely continue to be so into the future, perhaps of the very far future. In our almost top spot at number 2, we have Brookfield Corporation with a ticker of BN. They are based out of Toronto, and like BAM, they are also a leading global alternative asset manager. The difference mainly being that Brookfield Asset Management, or BAM, is structured as a premium stock with higher dividends, while Brookfield Corporation, BN, is more of a growth stock. Their current price at the time of recording comes in at $61.70. They have a market cap of $95.61 billion. Their beta, pretty volatile at 1.74. Earnings per share coming in at 0.78. Their price to earnings ratio, it is up there at 79.10. That return on equity, that's coming in at 2.31, and their return on assets are coming in at 2.1%. Their debt to equity ratio, that is coming in at 144.73%. And once again, when the old Brookfield Asset Management split into BN and the new BAM, BN took all the debt. So BAM started off with nothing. So this is kind of expected. Their yield currently comes in at 0.713%. It is a quarterly dividend of 8 cents USD per share. The payout ratio on that is 52.63%. So, as BN was also spun out back in December of 2022, this is also a 1 year, 8 month data pull, and that return on investment for 1 year, 8 months is 40.04%. Total return, 41.22%. On their 1 year, the return on investment comes in at 34.48%. Add in the dividends, we get a total return of 35.16%. Year to date, that return on investment comes in at 17.30%. Add in the dividends, we get a total return 17.76%. Brookfield Corporation is known for its strong track record of delivering consistent returns through diversified investments in real assets. The company's leadership in renewable energy and infrastructure absolutely positions it well for growth, especially in an era of increased focus on sustainability. In our top spot at number 1, we have Fairfax Financial Holdings with a ticker of FFH. They are based out of Toronto, and they are a holding company that, through its subsidiaries, is engaged in property and casualty insurance and reinsurance, as well as investment management. They are invested across 100 countries, so they have that global diversification down pat. Their price at time of recording comes in at $1,500.01. This is a pricey one, but they are available for fractional shares if your broker supports them. They currently have a market cap of $34.47 billion. Their beta is a little bit less volatile than the market average at 0.83. That earnings per share comes in at 224.25. They have a price to earnings ratio of 6.69. Their return on equity, that comes in at 17.91, and they have a return on assets of 4.27%. Their debt to equity ratio, that's coming in at 40.13%. Their dividend has a yield of 1.332%. It's an annual dividend, so only once a year, and that works out to $15 USD per share. The payout ratio on that is 9.20%. When we switch to the returns, on the 3-year return on investment, that comes in at 163.92%. Factor in the dividend, the total return comes in at 174.06%. On the 1 year, the return on investment comes in at 33.22%. Total return after you add in dividends, 34.92%. This year, year to date, the return on investment is coming in at 22.75%. After we sprinkle in some dividends, we get a total return of 24.32%. This company has often been compared to Berkshire Hathaway, and I can kind of see why. That probably means we are not going to get a stock split with this one. Nonetheless, if they stay on the current trajectory, this could be a stock we wish we could have gotten in on early for sure. I will say that I do currently hold 2 of these stocks in my 0 to 100K challenge, so they are a nice batch for sure. If you are interested in any of these stocks we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on total return ETFs, and I will see you in the next video.